Well, good morning to our listeners in Europe, good afternoon to those in Asia, and good evening to those joining us from Australasia as well. And thank you all for joining us for this week's OMFIF briefing. This is a new series by OMFIF. It's a weekly OMFIF commentary on the economic and financial impact of COVID-19 and the ramifications of the outbreak around the world, but also we'll have a particular focus on Asia this week. My name is Adam Cosman. I head up the Asia office of OMFIF, and you are joining me from my echoey temporary office here in Singapore, where you'll have to excuse any background noise from the construction of a new metro station near my home. There is a high level of social control here in Singapore, so development hasn't ceased and construction projects continue despite halts to labour and material supplies. Now on the call today and joining us, we have OMFIF's Asia Chairman and former Managing Director of the Australian Future Fund, Mark Burgess, who joins us from Melbourne. Grant Spencer, former Acting Governor of the Reserve Bank of New Zealand. Grant is in Wellington. Also with us is Mangal Goswami, who is on leave from the IMF and currently Executive Director at the Southeast Asian Central Bank Research and Training Centre, and he's in Kuala Lumpur. Now, in terms of format, we'll dedicate the first half hour for a panel discussion, which will be moderated by myself. We'll then have a Q&A with the listeners. Given the number of people listening in, we'll only collect questions in written form and not through the raising hand function on our webinar platform. So I'll ask listeners to either email questions to asia@omfif, that's omfif.org, or submit through the question function in the webinar software. I think this is a good time also to remind you that you can subscribe and receive our updates by going to our website and going to OMFIF, that's omfif.org/subscribe. And there you'll get a daily update on the different forms of analysis and virtual events that we're currently holding. Now, on the day when global cases of COVID-19 passed 1 million, we'll be taking a look at how global economies are continuing to reel from the pandemic. In Asia and the Pacific, the impacts of the pandemic have reverberated soundly among its population and in its network of vital supply chains. So Pat, I want to go to Grant first, and it seems clear now that recovery is going to be staggered, but how bad will this global recession be, and how long do you think it will last?
Well, that's a very big question, and clearly the recession, the length of the recession is going to depend very much on the length of the pandemic, how long it takes to get over the curve, and therefore how long the lockdown will last for. And, you know, with the phasing, that's going to go across a number of countries. But if you assume that most activity is going to be locked down through the second quarter over the next 3 months, then my working assumption at this point would be that the bottom of the rather flat V would be the second quarter. I think that's what most authorities are working on at this point. So in terms of quarterly GDP, that would give us a flat V shape where the second quarter is actually quite a significant reduction in the order of sort of -10 to -20%. A lot of people are talking about those scale numbers for the second quarter. Then, assuming things start to come out of lockdown, then you could have positive growth rates for the third and fourth quarters. But overall, you know, the recovery and the actual level of activity, I think, is unlikely to be back to the beginning of the year's level. And so the average for 2020, I'm pretty sure most people would expect it to be below 2019, so that we'll have a negative growth for global growth in 2020. And that's certainly the view that the IMF has taken. So, you know, in terms of, I think in terms of growth rates, there'll be a sort of a V shape with the Q2 at the bottom, But I think in terms of levels, it's going to be maybe 1 or 2 years before the level of activity and rates of unemployment get back to sort of pre-crisis levels.
That doesn't look overly positive at the moment. So we'll move on to Mangal now. I mean, how do you think Asia, and in particular Asian emerging markets, are going to fare?
Thank you, Adam. Again, this is sort of a risk, a tail risk that is unraveling of systemic proportions. What we have seen is that in emerging market, all emerging market assets, including that of Asia, have seen a massive sell-off. Just to give you some perspective, this has been the largest emerging market outflow of non-resident capital, and I think IIF has estimated it to be about in the vicinity of over $60 billion in the first quarter of 2020. So there has been pretty much no discrimination across emerging market assets, be it bonds, stocks, or FX, and also across countries, be it having a good fundamental or not having a good fundamental. So this has been pretty much across the board. However, you know, Asia has seen some experience through this kind of a crisis in terms of the SARS, but of course the scale is very different. The ASEAN economies are now much more exposed to Chinese demand and to disruptions in Chinese production, including the supply chains. And then we have disruptions in the auto and electronics sector. Of course, not to say the least, the tourism sector is going to be very significantly affected. So if all of this sort of, you put it all together, Asia, the economic downturn is going to be highly correlated to that of China, as well as to that of the global economy, including the US. That said, you know, we are likely to only see some semblance of bottoming out, you know, once the health crisis is arrested. Without that being arrested, I think, you know, this is going to continue to drag on. After we see some semblance of bottoming out in the markets, we are likely to see investors sort of, you know, differentiating between countries, emerging market countries in Asia, especially in Asia, who are have better fundamentals in terms of vulnerability to external and fiscal vulnerabilities. In that respect, I think, in relative to the previous crisis, and as we have seen in the global financial crisis, Asia sort of stands in good stead relative to other emerging market countries. If you look at any metric relative, you know, including FX buffers to macro policy framework, monetary policy framework with more adjustable exchange rates, flexible exchange rates, more buffers in the banking system. So that way, I think Asia may be a bit better prepared, but that said, the depth of the crisis is clearly, you know, uncharted territory right now, and we can talk more about policy responses later.
Yeah, no, I think you're right, and I think it's very important to make that distinction between this being an economic crisis compared to previous crises that this is often compared to, be it 2008 or 1997, which very much financial crises. I mean, Asia proved to be remarkably resilient in the face of the 2008 crisis. Financial institutions are certainly better capitalized than they were in 2008. But Mangal, do you think we're going to see or run into any liquidity problems? And are central banks ready if we do?
Yeah, I mean, clearly, if 2008 GFC shows anything, that Asia was better prepared and emerging markets were better prepared on average. That said, you know, of course, the Basel III has helped, especially the systemically important countries within the emerging market world who have higher capital and liquidity buffers. However, what has really happened, I would like to highlight here, is that a lot of capital has moved to the sector where risk is least regulated. That means we have been focusing on the banking system, while risk, clearly a lot of capital has moved to the non-bank financial institutions. And that's where probably the vulnerability in terms of liquidity will arise most. And that's where I think central banks have to be more innovative, have to be more ready to provide more creative solutions to liquidity backstops. And we're already seeing signs of that. You know, across Asia, if I can give you some examples, we have seen Thailand being more innovative on its liquidity provision. We are seeing a series of Asian countries, including India, Indonesia, Philippines, actually, doing whatever it takes in terms of their using intervention to buy, sovereign bonds to sort of allay that fear in that market, to sort of provide liquidity to that market. So, besides traditional monetary policy provision of liquidity at the short end, there's also expansion of liquidity at the long end through open market operations, which are much more longer term. So we are seeing all of this, but one thing definitely is clear in emerging markets: the risk had moved to the non-bank sector, and therefore the central banks have to be more responsive to being the not just the lender of last resort in the traditional way, but maybe the dealer of first resort, in the sense that they intervene in the market to sort of provide a little bit of a bottom to the market. And we are seeing, as I pointed out, stabilization funds that may even be at some point extended beyond sovereign bonds, and we are seeing the installation of credit policies and the likes. So that's where we are. I think the policies have been very, forthcoming, and of course, no one knows the depth of this crisis. So liquidity provision will be a very important part of this equation.
Thank you,
I think Mangal's hit a point there about, shadow banks and even the corporate world, because this liquidity shortage is economy-wide. So traditionally, the central bank tools, through purchase of high-quality assets and taking high-quality collateral, will liquefy the banking system. But the big question is, can you liquefy and keep afloat the non-bank sector, the shadow banking sector, and also parts of the corporate sector? Who's going to take that risk? Because central banks typically don't want to take that sort of low-grade credit risk. And so I think a number of central banks around the world are struggling with this issue right now about the quality of paper they're willing to take. Are they willing to take non-bank shadow banking paper or corporate paper directly? Where do they stop, and where do they say, no, to go any further, the government has to underwrite this? So it has to be a government guarantee before the central bank will come to the party. And different central banks are taking different approaches, but this is where the stretch comes in, and we'll see different approaches in different countries.
Thank you, Grant. Yeah, I think that growing burden of indebtedness has led many to expect we'll have some sort of credit meltdown at some point or the other. Mark, just on the issue of liquidity, the virus outbreak has piled a lot of pressure on Asia Pacific's pension industry, because some of the funds face liquidity issues with withdrawals happening. And I suppose, given how the Australian markets have been performing, this situation could be quite severe in Australia.
Yeah, I think the Australian pension system, or the superannuation system, is somewhat unique. It's very large by probably world standards, but does allow things like switching, and does allow things that can create a shorter term movement of pension assets between pensions. But the government down here, to stimulate the economy, is also allowing people to withdraw money, which is a surprise to the industry. But I think the question you're asking is a broader one, not just to Australia, which is, one of the themes that we've seen here in the last, really prior to the GFC, was the notion of the great moderation, which is that low economic volatility was becoming assumed by markets. And interestingly, we had the great moderation reappear in the last decade and become more believed, particularly in the last 2 to 3 years. Not talked about, interestingly, but believed that if rates were low, as long as the volatility of the economy was low, then prices for risk assets could be high. And then that cascaded into other things. Things like holding more illiquids in portfolios became fashionable, not just for the return, but because of a sense of stability in the economy. And so we often hear the economy talked about, will it grow or won't it grow, and by how much, which was clearly a disappointment post-GFC in terms of low growth rates. But what re-emerged was low volatility, and the markets were absolutely primed at their peak at the assumption of low volatility. And now it's trying to unwind. And the structural unwind includes the short-term violence of the reaction to that, but also the fact that some portfolios have illiquids in them on the assumption of low economic volatility, which were attractive places. And so things like VC investing or private equities had an absolute boom. And this is things across the world that pension plans are having to struggle with because their asset allocation weightings have changed. I think this is going to extract enormous capital out of those sectors and reset many of them. But remembering, many of them have recently raised money, so things like private equity will also help support the equity market. So there's a lot of that dynamic about the stability of the economy being shocked. I was in the US 6 weeks ago, and the first week, and I met very famous investors over a week, no one mentioned the virus in the US. And so when it actually became conscious, it was a massive shock, and that's why we're seeing such a violent reaction.
Yeah, no, thank you, Mark. I mean, obviously the crisis is really affecting investment positions. So, I mean, what are some of the longer term themes investors and policymakers will need to consider?
Yeah, look, I think many of these are probably known by those who are on the call, but often in a major correction, we get the beginnings, and the beginnings are already beginning to show themselves, but they become more prevalent. So some of the major themes here, for example, will be globalization. We know it's under pressure. This only puts more pressure. We know, for example, that the assumption of low economic volatility and illiquidity in portfolios. We know the pension plans around the world are badly structured. Now they've been set back enormously. This does huge damage to balance sheets, and particularly in places like the US. I think one of the interesting ones, and there are about 8 or 10, or you could probably come up with more, I think it's really interesting that once again, we're calling on the central banks to bail us out. And this time it certainly feels like they're having to do it in the most creative, and as has already been mentioned by Grant and Mangal, a creative and interesting way. If for some reason this goes on for longer than expected, will the confidence of central bankers be shaken? Because the assumption of a floor under the market has been going on for 35 years, and it has becoming less and less effective, in my opinion. So far, it appears as though it will be effective for this cycle, but gee, it really is very, very stretched. And I think markets might think that through a bit more if the virus lasts for longer than expected, because at the end of the day, the length of the virus is an exact measure of the degree to which the scale of this requires intervention.
And Mark,
I think that's a good point there. Sorry, Adam, I think it's a good point Mark says there, that basically the central banks right now are turning all the taps on. The taps are on full. So, this is really letting the economy have it with the full force of liquidity policy and everything they have in the arsenal. So, when we come to the recovery phase, I'm not sure there's any role left for monetary policy there. It's got to be something else. Either it's going to be a self-starting situation, or it's going to be fiscal policy called on to boost the recovery. But the ammunition of the central banks, I think, will be pretty well exhausted with what they've done already over the past month.
Thank you, Grant. I mean, I don't want to, before moving away from the issue of central banks, I just want to talk about this week's announcement from the Fed and its dollar lending programs, which I suppose aims to help alleviate some of the market strain. But I mean, regional initiatives in Asia previously, such as the Chiang Mai initiative and others, have taken steps towards reducing regional dependence on US dollars for liquidity. Obviously, those initiatives probably remain inadequate, but is this crisis again a sign that the globe, and particularly Asia Pacific as a region, has become dangerously dependent on the US dollar? Mangal, what are your thoughts on that?
I mean, clearly the announcement on the FX swap lines to select countries and the follow-up to that on the repo side does add some, provide some bottom in terms of FX liquidity shortage for emerging market countries and the likes. But I would say that there is a bit more nuance to that story in terms of the over-dependence on US dollar. In terms of a lot of the Asian countries, emerging market countries that are market access, what you saw after the financial crisis, Asian financial crisis, is that clearly the sovereigns understood the FX mismatch issue. And you will see most sovereigns have switched to local currency rather than foreign currency in terms of sovereign issuance. But what has happened is at the same time, they've opened up their markets to foreign investors to diversify this investor base. And what that has created is a new kind of risk, because that's still an external liability, especially when the investor wants to take that money out. It becomes an FX liquidity mismatch, despite the fact that the sovereign has sort of put that currency risk on the investor. You still have that ultimate risk if people sell that asset. So that's one thing that has been driving part of this external sort of risk for Asia in terms of our emerging markets. On top of that, again, I go back to my previous story that, you know, the risk has shifted, the capital has shifted to the non-bank financial sector and corporates. You will see, if you look at the data, you will see most of the dollar exposure or foreign exchange liability exposure emanates from the non-bank financial sector, and the increase from non-bank financial sector as well as from the corporate sector. Basel III and also authorities in various countries have focused a lot on the banks. So the risk is now in the NBFCs and corporate sector. So that's where more and more sort of macro pru type or prudential regulations will have to be implemented over time. This will be a learning experience, of course. You know, that FX mismatches having shifted from banks to non-banks is something that needs to be addressed urgently. Many countries are addressing it. You know, Indonesia has done certain macro pru on hedging requirements. Thailand has, many other countries have done. But you know, clearly this is a risk that has evolved over time. And you know, how can you not borrow in dollars when it's so cheap, right? so that addiction, when the drug is quite cheap to get, is an easier one. And therefore the corporates have you know, done so, and hedging markets in Asia are not very deep. So much of it is probably, a large part of it is somewhat unhedged.
And Mangal, do you think there's, well, I suppose within Asia, are there particularly any countries that are more vulnerable?
I would stay away from pinpointing countries, but at the same time, I think you know that, you know, countries that are more market access countries, countries that are relatively more open. Of course, you know, we know that you know, Malaysia has a very large proportion of foreign ownership in sovereign bonds, over 40%. Indonesia corporates may have borrowed in this market. Even China, right? We know that, you know, China's, although external debt is low, but there are certain vulnerabilities in FX, you know, corporates or others borrowing externally. You know, many other countries have also done so, but I would say that most countries, including Indonesia, Malaysia, they also have built FX buffers, reserve buffers. So if you look at their reserve adequacy levels, clearly their reserve adequacies are quite adequate at this point, given the potential outflow from their future, you know, dollar liabilities. So there are certain buffers that are there that mitigate this. Nonetheless, the scale of this is quite significant.
No, quite. I think just a moment, I just want to remind everyone that we are able to take questions. So if you do want to send them in via email to asia@omfif.org, they'll be able to be filtered through to me. I may not be able to use all the questions, but I'll certainly weave some of them into the dialogue that we're having. I mean, there was one that's come through, and I'll probably direct this to Grant. Probably quite an obvious question, but what does all this mean for central bank independence? Is the world moving towards a new paradigm where central banks in Europe become much more like those in Asia, autonomous in just a few areas of decision making? Grant, what do you think of that?
I think this is a question that was also raised back at the time of the GFC, in the sense that if the central bank gets to the point where it's undertaking quantitative easing or effectively supporting parts of the economy that it wouldn't normally support and taking significant credit risk on, for example, non-bank paper or corporate paper, then it effectively starts to take on more of a fiscal type of role rather than a pure central banking role. And that does raise the question of the degree of independence that some of those central banks may retain. So that's a reason why central banks have to be very careful about the extent to which they underwrite the economy, as opposed to leaving the underwriting process to the fiscal authorities. But at least to date, and in the wake of the GFC, independence was pretty well maintained, and I would hope that that can be retained through this crisis as well.
Thanks, Grant. I was just sticking with you for the moment and following on from a comment you made at the beginning. I mean, pandemics routinely appear high up on the government risk registers. But do you think governments around the world have done enough to understand the way the different policies intersect? You mentioned before the role of monetary policy and fiscal policy. Are the tighter mobility restrictions being accompanied by enough fiscal and monetary support?
Well, I think there are two aspects of policy design that I think are important in this situation. One is to make a clear distinction between the supporting incomes and supporting people through the hibernation phase, through the lockdown phase, and then policies designed to promote recovery. Because there's no point in running demand-supportive, demand-boosting policies at a time when you have the economy in lockdown. So that would be like pushing your foot on the accelerator and the brake at the same time. So you have to be very careful to separate those two things. The other aspect I would highlight would be a lot of these support packages are being implemented through the business community. And it's fine for that transitional short period, but there's a risk in my mind that if those are perpetuated, you can perpetuate firms that are not sustainable. And the shape of the economy after this crisis is going to be different. And so resources need to shift in different directions. So governments have to be careful that they don't prop up companies that are not going to may not be sustainable in the new world. For example, companies, that are close to travel or tourism or some of the service sectors that are going to be more heavily impacted over the medium term. And so there it's important for support policies to make sure they're going to people rather than propping up potentially zombie companies.
Thanks, Grant. Mark, I just want to see if you want to build on that. I suppose one of the questions I have really is, Grant mentioned that the shape of the economy is undoubtedly going to change after the crisis. But as this crisis develops, do you think the trade-offs required to overcome the pandemic are going to get harder?
So the trade-offs to overcome the pandemic between now and the solution to the pandemic, Adam?
Yes. Yeah.
Yeah, look, it is going to get harder. And the thing is, this opens up this question, and probably none of us can easily answer this, but is the length of the pandemic and how it works. And it seems to me that it was interesting, the V-shaped, so-called V-shaped recovery that assumed that the bottom of the V would be obvious. But it's going to be staggered. And you know, we talked before about some of these longer term themes. One of the themes in Asia will be the strongly demographic countries of India, Indonesia, etc. But we could have a period here, and let's hope it doesn't happen, that these countries take quite some time to be in the all clear, let alone the human costs of the virus and the pandemic working through these very large populations. And so it's going to be a staggered process. So as countries that are coming out the other side, you know, do well, they may still limit travel, for example, from these countries, or they may limit supply chains. And we hear stories, and I'm sure it's well understood by everyone on the call, but supply chains are under huge pressure. And what we're finding is that people are ready to open up, but they're getting a supply of a certain item from, let's say, India, which is only just beginning to go into it. And that's affecting their entire supply chains in what I'd call normal products. And so this kind of staggering process and this working our way through it has the hallmarks of it's sort of just not going to be easy to create the V, because it'll be a series of kind of setbacks, let alone those countries that come out the other side are almost certainly going to have to ring fence some people from time to time if outbreaks reappear. And so this is going to go on for a long period. And it'll be interesting to see what governments think about this, because their packages are all contingent currently on providing liquidity to corporates for a defined period, which I would think is about 3 to 4 to 5 months at best. And they're going to have to decide how to manage that. Otherwise, the fiscal side and the debt outstanding, even if we come through with a good recovery at the end, will be so large that it'll really affect the dynamics of our economy. You know, I say to a central banker who's prepared to raise rates in 2 years' time with the new level of fiscal debt on balance sheets, it's going to be capping that out. What does that do to the state of the economies on a 2 to 3 year view? I do think markets are going to start thinking this through pretty soon.
Yes, no, that's a fair point. You mentioned, sorry, Mangal?
Yeah, I just want to weigh in on this to mention, as Grant mentioned earlier, clearly we learn our lessons from every crisis. And this one is quite different, right, from the past few. And we are learning every day and recalibrating. So there, I think a common framework seems to be emerging. And this framework, as Grant sort of alluded to, is that we need to first and foremost stop the economy, have the lockdown, and have a deliberate public policy to arrest this pandemic from spreading. That's the priority of public policy now. And once, and people need to understand that this is the situation, and they need to internalize this and this risk. And this period is when the economy will shut down, and only very, very important sectors that need to be open will be open. Once people regain that sort of confidence that they will be healthy, their family will be healthy, their co-workers will be healthy, will they go out and again try to boost aggregate demand through consumption, spending, investment, and the likes. Until and unless we see this confidence return, it is going to be very hard to actually push on aggregate demand, because it's going to be pushing on a string, right, as you mentioned, Grant, earlier. So clearly that trade-off is going to be there. This trade-off will depend on how long it takes to arrest this. Therefore, all sort of fiscal resources and resources, private resources, need to go to sort of addressing this health crisis. I think that's first and foremost. Because in Asia, especially, you will see countries, most of the Asian emerging market countries, they have the fiscal headroom and they have the monetary headroom in order to provide that stimulus. but that stimulus is only going to have multiplier effect if you are at a point where aggregate demand can actually be boosted after gaining confidence. Thank you.
No, thank you. I mean, it's quite clear that there is a bit of a correlation in global policies to this. The IMF, of course, has set up an excellent policy tracker which summarizes the key economic responses from nearly 200 governments and the policy responses they're taking to limit the human and economic impact. There does seem to be some sort of framework emerging, as you rightly say, Mangal and Grant. I just want to move on to China, obviously the powerhouse of the Asian region. I mean, China's 2020 GDP is set to slow to just above 3%, which is the lowest since 1976, and a lot lower than the last few decades of its meteoric rise. So, I mean, is this the Chinese economic trajectory is peaking? Mark, you travel often to China as well as the US. What would be your thoughts on that?
Yeah, look, I think China themselves are aware that their economic growth rate was going to come down, and you know, while it's not an official policy, I've always believed that around the 5 or 5.5% growth rate is the sort of core growth rate in this period of China's development, and given its scale and magnitude. I think it's interesting, and perhaps the other panelists will want to comment, but you know, China appears to have approached this in a thoughtful way under an enormous duress. I've been impressed by the fact that China was dealing with the outbreak of the virus and the crisis, while at the same time working very aggressively with the financial sector and knowing that this was a cash flow problem very, very early in the policy development, it appeared to me. Also, China appears to be at least holding on to some of its other lines, for example, not compromising unnecessary credit creation. It has going to create credit here, it is going to create government deficits, but it appears to be well considered in the way it's doing that. In other words, it's keeping in mind its long-term strategic objectives and what it's been working on in the last few years, which is it needs to fix shadow banking and it needs to stop having the financial system become unbalanced. They keep trying to get those combinations right. At its core, though, China's growth rate, in my opinion, is on a secularly lower level. It will rebound, although it is contingent. The last thing I will say, which is perhaps obvious to everybody, unfortunately, there is this issue developing of the relationship between China and the US, and clearly the virus is setting that back. And unfortunately, it's a bipartisan fear, and we, hopefully for the sake of the world, we can get that resolved in some form in the next 2 to 3 years, because globalization has been very beneficial to the entire global economy.
Thanks, Mark. I suppose with the US-China feud and its impact on trade and the possible build-up of tariffs, I mean, countries like New Zealand and Australia and other similar sorts of resource-rich countries, there must be concerns about whether this will be a period of time or possibly an excuse to build up tariffs. Grant, perhaps that question first to you.
Well, I mean, we've seen the development of the trade wars, obviously, between the US and China in the last year or two. But in terms of that spreading to other countries, we haven't seen a huge flow-on effect. I think most countries realise that that is a recipe for even more rapid deglobalisation and was going, at the end of the day, to hurt everyone. So certainly in this part of the world, I think the governments have no intention of sort of joining that war. If we're to put up tariffs, would only hurt our own economy. We do have buffers. I mean, we're certainly vulnerable to commodity price movements, but we also have flexible exchange rates that at least absorb some of that shock. But I wouldn't expect either Australia or New Zealand to start looking at participating or joining a trade war.
Thank you, Grant. Mangal, this is a question from the audience, builds on Grant's and Mark's points, but some say the virus is killing globalization. It'd be good to get your views, and then also how a country like Singapore, with an open economy, which is also plugged into an open trade regime, can respond to a new order
That's a very, thank you, Adam. That's a very loaded question. All I can say at this point is that, despite social distancing, economic distancing is not going to happen after this dust settles. We are clearly on a path for continued globalization. I mean, if anything, this may even strengthen the resolve, in the sense that maybe this sets the economies back a little bit. So there'll be even more urgency to continue towards globalization. That remains the answer to it. But what this really reveals is that, we should not only think of macroeconomic real shocks, as well as shocks coming from the real sector or shocks coming from the financial sector. We need to think about the other sort of black swan type shocks, such as the pandemic, and that needs to probably be factored into the policy framework.
Thanks, Mangal.
Just on that point.
Yeah, please, Grant.
In terms of the trend to the globalization theme, I mean, in the very long term, Mangal may be right that we sort of get back onto that, but I suspect that this crisis and the pandemic will, to some extent, reverse the globalization process, at least over a period of sort of maybe 2 to 3 years, because once the regulations and the lockdown comes off, I think international trade in goods will continue, but international trade in services will be slow and only recover at a very slow rate, because international travel of individuals is going to be really, there's going to be sand in those wheels, I think, for some time to come. So I think that's going to be a negative factor for countries that are dependent on exports of services, where people are involved. And I think I would think Singapore would be one of those countries, I'm sorry to say, but that where that factor, that slow recovery in trade and services is going to be a bit of a drag on economies like Singapore for maybe 2 or 3 years. But as Mangal says, I mean, beyond that, when things really normalize, maybe we get back onto a more globalization track.
So do you think it could be more of a recalibration of globalization? I mean, do you think there'll be more regionalization, more regional integration as a result of the crisis? So, Grant.
Well, at least, as I say, in the medium term, 2 to 3 years, I would think that is likely. I think, as Mangal and Mark referred to, the supply chain disruption of international supply chains, and so I think production is going to become more concentrated in individual countries, where the domestic economy is going to play a relatively larger role. And as you say, that will promote maybe some more regional initiatives rather than the full global economic model that we've had over the past decade or so. And of course, this was already coming under some threat from, of course, the trade wars that we've seen over the past year or two. And I think the COVID pandemic is sort of, to some extent, reinforcing that trend.
Maybe if I can just...
Yeah, Mangal first, and then I'd like to go on to Mark with the same question as well.
Just very quickly, I just wanted to say, I mean, absolutely, in the services sector, there is going to be quite an impact, especially in the areas where human touch is involved, in the airline industry and the hotels and the likes. There is one dimension to it that's beginning to really show up, is this whole intangible IT part of it. That's taking off in a crazy way. I mean, we are talking here we would have never convened this panel through an e-panel. We would have flown in and the likes to do this. So there are some positive sort of productivity enhancements to be teased out of the other side of the services sector that may help mitigate to what Grant is talking about. I mean, clearly, they are important issues, but that may help mitigate some of it. There are apps being discovered every day to do new things, so that may help in mitigating some of it.
Thanks, Mangal. Just moving on to Mark. I mean, back after other crises, especially which affected hotels and transportation, like 9/11, a lot of people talked about the change of working habits, which didn't quite materialize because the technology probably wasn't there back then. So now we've moved on a few years. Do you think the advances in technology could fundamentally impact the way we work? And could this then have an impact on globalization and regional integration?
Yeah, it's an interesting question, isn't it? You're absolutely right that normally we do things like this and we assume now this is going to be a new trend. But look, I think pretty clearly there are already some underlying trends out there. So for things like, for example, the pressure on retailers is just going to pick up. People are going to become even more accustomed, and it's just going to be part of a trend that's going to continue to cause challenges as people adapt. But yeah, things like travel, it's already been mentioned. We've had a boom in global travel, both from a tourist point of view, but also business. People are getting used to this environment, and if this virus plays out the way I expect, where it won't just be a sudden recovery, but there'll be patchiness to it. So, for example, someone in your office gets the virus in 6 months, it's otherwise under control, but your office has to shut down for a period. People will go back to this kind of interaction. And so it's going to be a practice process. And yeah, it'll be interesting to see what happens. I think you're right. I think it's teaching people other skills. And people, the one thing that should give us a lot of optimism is humans are adaptable. And you can see it, adaptability going on everywhere, whether it be working on a solution to the virus or whether it's working on how to keep the economies together. And this will be one factor.
That's very good to hear. Because humans can be relied on for being adaptable and not the weakest link in most of those chains. So I just want to remind everyone that we are able to accept questions, and you can send those via email at asia@omfif.org. We just have a question, and this moves us back into the central banking world. Perhaps mainly for Mangal and Grant, this question, Mangal, if you want to answer it first. But are Asian official reserves liquid enough to cope with the scale of potential outflows? We had the same doubts during the GFC, but can central banks in emerging markets emulate asset purchases and debt finance deficits of advanced economies? Mangal, would you like to tackle that one first?
I couldn't quite catch the entire breadth of the question, but if I understand the first part correctly, let me get to it now. On the FX reserves question, first of all, most Asian emerging market countries that are market access are sort of have reasonably adequate, more than adequate FX buffers. On top of that, FX foreign reserves by definition is largely liquid. Many countries have carved out part of the foreign reserves as sovereign wealth funds. You may think about them as being partly liquid, partly not liquid, but foreign reserves by definition generally is largely liquid. So to be able to deploy the reserves to forestall any significant stress is clearly not that difficult under the circumstances. And of course, we have several sort of backstops, including now we are hearing that the IMF has a significant war chest to deploy to emergency liquidity and the likes. But I couldn't really get the second part of the question.
Well, maybe if we can take the second part to Grant. I think it was particularly aimed at seeing whether emerging market central banks would likely emulate the asset purchases and debt finance deficits that a lot of the central banks in advanced economies have created over the last 10 years.
You're talking about replicating QE type programs.
Pretty much, yes.
Well, I guess, you know, when countries, when they get to, they reduce interest rates, they get to the zero lower bound or something near that, then they start to look at QE programs. Generally, I would say the Asian countries have had interest rate structures that have been well above the larger developed countries, and so have so far avoided that dilemma of facing when they get near the zero lower bound. So I guess time will tell through this crisis how quickly some of the Asian countries will get their interest rate structure so low that they may have to consider QE. But I guess that varies across countries, and we don't want to talk about particular cases. I would add, though, on the liquidity of reserves, that has been recently enhanced. I think where the Fed now has a facility where they will buy US Treasuries directly. They open a window for international holders of Treasuries to come in and basically discount them to sell them to the Fed and receive cash, which has added sort of an additional dimension of liquidity to a lot of those US dollar reserves, which are usually held or very often held in treasuries.
Thanks, Brian. Mark, just building on that, but more onto the sovereign wealth fund space, do you see that sovereign wealth funds and public pension funds could be possibly directed by governments and other bodies to invest into infrastructure and key assets that are vital to the functioning of each individual country?
Yeah, look, I don't see it in the short run, Adam, but it is an interesting question because what we're seeing here is a very significant expansion in the fiscal in the balance sheets of governments. Some of that's owned by the central banks, admittedly, but this is kind of a shock to the system. And if this gets extended out, where we have to have very sizable deficits for even longer than we currently expect, then the fiscal room for governments is going to be compromised. And there is a prospect that they may start to think about the role of their pension plans and the role of their sovereign wealth funds. That said, it may also be advantageous for sovereign wealth funds to consider this because the next stage of the cycle here, rates will already be low, and they've had a benefit of 30 years of falling rates, which has lifted the value of all their investments. And finding creative ways to deploy capital could also be the advantage of sovereign wealth funds. And so, you know, if the two can come together, I think that is possible. The danger, of course, is that sovereign funds or pension plans become a political tool, and that will undermine the integrity of that system, and that could be quite poor for the medium term. So I think hopefully the two can work together because finding good investment ideas and returns is not going to be easy, and these are good pools of capital. So let's hope they can do it in a sort of professional way, but not in the short term.
Thanks, Mark. And I just want to come back to China again and ask yourself again, Mark, we talked about China as its growth outlook, but what do you think the pandemic will do for China and its standing in the world? Do you think President Xi is going to be able to consolidate his role on the world stage, or will people in the end just blame China and will it lose out internationally?
Yeah, I kind of alluded to this before, is that, you know, in my travels to the US, what's concerned me in the last 18 months really has been a kind of a strong anti-China view on both sides of politics developing. I don't think it's healthy for the US, and it's not healthy for China, and I believe China is obviously very aware of it. Unfortunately, the virus did start in China, but gee, viruses have started all over the world over history, you know, we just need to be careful with that. But in the current environment, this is not a helpful strategy. That said, it is a big world now, and our region has very strong growth characteristics, and maybe we get regionalization, and maybe this isn't as significant to the world growth profile as we expect, but we're in for a tricky period. I guess on my list of wishes, I hope we go to a world where diplomacy is the top of the list of tools, because I think actually just we won't get a chance to talk about today, but think one thing that's come out in the last few weeks is that central bankers collectively have worked pretty hard together and come up with some pretty good policies in timely ways. We need diplomats to work in the same way if we're going to get a truly interactive world. I'm not as confident that this is going to work that well.
Okay. And I mean, building on that, really, I mean, we've seen that there's a possibility that if the Chinese Communist Party was able to restart the economy quickly, restore daily life, while countries like US continue to struggle to do so, do you think in any way could promote a strong centralized state? And could that idea get more traction? I mean, the way China and other countries have dealt with it are in quite stark contrast to how the US is dealing with it. Of course, the US is a far more decentralized country. And Mark, if you want to just finish on that question as well.
Well, that's a hot topic, and so this isn't a view whether this is a good idea, but whenever you see things like this, clearly kind of perceptions and lessons get built by the population about what's going on around them, and maybe people in some places will say that degrees of control are better for the long-term society. I'm not necessarily advocating it clearly, that's just a personal view, but yeah, this is a really interesting period in history, the next period, because we already had these underlying issues bubbling away. And the virus has kind of emphasized some elements of this, as you pointed out, let alone the role of technology and what technology is doing and where privacy and other things come to play. It's going to be an interesting period.
Thanks, Mark. So we've got 4 minutes remaining.
I would say just...
Please, Grant.
I was just going to say, I wouldn't expect the centralization of power, more power in the US, but I think there will be a learning, like after every crisis, there's this learning process afterwards, and that will happen. And so there'll be frameworks and policies put in place to better deal with the pandemic, both domestically and international. There'll be international cooperation, but whether the next crisis is going to be along the lines of this one is another question. But just in that regard, I've read some people say that Hong Kong has dealt with this crisis better because they had to go through SARS, and so they were better prepared than most other countries for the COVID pandemic. But so there'll be a learning process, but I don't think that will necessarily mean a fundamental change in the structures of government.
Adam,
thank you. Mangal.
I think there are 2 phases to it. The first phase, when there is this lockdown, there is going to be some heavy-handedness because you have to prevent people from going out, but at the same time you have to provide for them. Both businesses and households. And how do you provide for them? How do you channel fiscal resources to? It has to be fiscal resources or through the banking system where they are provided for during this lockdown period, which will be a bit more heavy-handed. Otherwise, you will be hard-pressed to arrest this health crisis. In the second phase, once people have more confidence in the health system and trust is back, then I think the markets and the financial institutions will have a significant role to play, because we already know that supervisors and regulators have already asked banks that the regulatory forbearance will be there, so they can use their cyclical capital buffers, the liquidity buffers to deploy, but they will be reluctant to do so until they see that this is actually going to bring them some returns. So the first part would be more heavy-handed, I guess, generally speaking, and the second part would be more sort of the market-driven forces, if you like.
Thank you very much, Mangal. Now we just have a minute left, and we've had several questions on this theme, so I just need to ask the 3 of you, how do you think this event will impact sustainable investments across the world, and how do you think people may think differently about carbon emissions, and how will the conversation around global warming be impacted by this pandemic? Of course, we're not traveling as much and flying around as much, so we're having immediate impacts in that way. Perhaps, Grant, would you like to try to answer that quickly first?
Well, I think it's inevitable during a crisis that the eyes will be taken off other policies, and so clearly there'll be some slippage in the programs that countries have for climate change and reducing carbon emissions. And I would also say that the big drop in the price of oil and energy will not will be a further sort of a deterrent to the growth of renewable energy, because that'll be relatively more expensive. But you know, having said that, one, as you say, the current situation is actually reducing emissions. There's no doubt about that. But then, in the medium term, I would expect the normal policy priorities and regime to come back into play. So I don't see it going away, and I think there will be refocusing on climate change policies. You know, maybe another 1 to 2 years down the track.
Thank you, Grant. And I think, given the time, we'll probably have to call it a day there. I'd like to thank the three of you again for joining us. It was an excellent session. And as I said at the beginning, this is part of a series of OMFIF commentaries on the response to COVID. You can subscribe to our updates regarding these at our website, which is at omfif.org/subscribe. And you'll get those updates into your inbox. Sorry. I'd like to thank the listeners who've joined us from Europe in the morning time, from those in Australia, New Zealand as well for joining us this evening, and for those in Asia as well for the afternoon. And thank you for joining us. Thank you for listening, and wherever you are, please keep on looking after yourself. Thank you.